ABCL Stock had its IPO in December 2020. The company planned to sell shares at $15 to $17 range and raise about $380 million in the public markets. The Nasdaq was making big moves at that time. By the time the shares opened to the retail investors, the stock price had already jumped to $60 a share. But with the recent cooling down of the growth shares, this has presented an attractive opportunity in the ABCL stock. ABCL Biologics was founded in 2012 by Dr. Carl Henson of Canada. He is a professor at the University of British Columbia. The company is backed by Bill and Melinda Gates Foundation and also by the early Facebook investor Peter Thiel and the DARPA. In this video, I'll do a basic fundamental analysis and a technical analysis of the ABCL stock and give a detailed strategy of how I'm planning to trade the stock. So please watch the entire video to get all the details. My name is Arshad Ahmed. I'm founder of DIYstockpicker.com, an investment portal dedicated to help investors make intelligent decisions. This video is only for information purposes, so please do your due diligence before making any investment decisions based on the video. So let's get started. Much of the recent attention given to the company has been due to its discovery of the antibody drug in treatment of COVID-19. The company had partnered with Eli Lilly and discovered the bamlanivimab drug, which is administered to patients 12 years and older. The drug has been proven to reduce severe illness and hospitalization in patients with COVID-19. The FDA had given emergency use authorization for the drug. ABCL has a drug discovery platform. This significantly reduces the time it takes for the drug manufacturers to discover new drugs. The company receives an upfront payment for the drug platform usage and also receives royalties for the rest of the life of the drug once it receives FDA authorization. This is a very asset-light model. Let's take a look at the fundamental analysis. ABCL stock has a market capitalization of $7 billion. If you take a look at the fundamentals of the stock, the company has net zero debt. This is very good because as the treasury yields are forecasted to rise in the future and the interest rates are going to rise, the company has no debt service payments to make. The company has a current ratio of more than 10. The current ratio is the current assets divided by the current liabilities. Anything about 1.5 is very healthy. The company has enough working capital since it is flush with cash from the IPO proceeds and also from the royalty payments from Eli Lilly. The price to book is 7.33. Usually, if the price to book is below 1.5, it is fundamentally cheap stock. The price to cash flow is about 14. This is a very good measure. If we take a look at the revenue growth has been exponential. There was very little revenue to show for in 2018 and 2019 of $8 and $11 million. But the 2020, the company had a revenue of $218 million after it received the FDA authorization for its drug. And if you look at the quarterly statements, this is hugely significant. In the first quarter of 2021, the company made almost as much money as it made in the whole year of 2020. If the company is able to maintain this rate of revenue, the company may end up close to $1 billion of revenue in the year 2021. If we assume a growth rate of 50% for the revenue, then in 3 years, the revenue would be close to $3.2 billion. And if we use a multiple of 10, that would give about $30 billion market capitalization for the stock. Now, if you look at the current market capitalization, it is about $7 billion. So that is almost a 4 times increase from the current market capitalization. So if the stock follows the pattern, the stock may be $100 in about 3 years time frame. But that's a hugely optimistic evaluation of the fundamentals. Let's do a basic technical analysis. If you look at the weekly chart, the trend has been overall negative since the company had its IPO. We see that once the company had reached even more than $70 a share. If you look at the RSI on the weekly, it is near oversold territory and it has always been there. There is not much data to validate that since this is a relatively newer company. But if you look on the daily chart, we look that the trend has been negative again. But each time we see the stock price has been dropping below the 44 EMA, and each time it goes to the certain level, it tries to go up and tries to break the 44 EMA. Sometimes it does break the 44 EMA, but again it comes back. If you look at the MACD line is below the signal line, but if you look at the gap between the MACD and the signal line, it is reducing, which means that there is a reversal in place. And the RSI is closer to the oversold territory on the daily chart. It has a lot of room to run in case the stock price rises higher. Usually I try to take stocks which are trending above the 44 EMA and which are close to the EMA. But ABCL stock is a special case scenario because of the pattern that I described, that each time the stock price goes well below the 44 EMA, it tries to break up and goes and hits the resistance at the 44 EMA. So something interesting is happening here. If you look at the past 3 days, the volume has been huge. Usually the volume has been 1 million shares exchanged on a trading day. But for the past 3 days, the volume has been very high, almost between 4 and 4.5 million shares. The stock has put 3 green candles consecutively and it's making its move towards the 44 EMA, and this is the opportunity I'm trying to capitalize on. If the trend continues downward, the 44 EMA would be somewhere around 28, 26 in the next 3 to 4 days. And if the stock follows this upward pattern, so the stock price can rise $26 levels all the way to $28 in the next few days. If I have $1,000 in capital, this is how I would trade the ABCL stock. Buy 35 shares at $26 per share. So the total price would be $910. I'll put a stop loss at $25.25. Now there are 3 conditions when I'll sell my stock. First, when I got stopped out, when my stop loss gets hit. The second is when the price reaches a resistance of $28.11 on the daily chart. Like I showed you on the daily chart how the stock is gapping up. And the third is when the MACD line reverses the trend and the gap between MACD and the signal line starts to increase again. We've seen on the MACD that the gap is closing between MACD and the signal line. But if the trend reverses, then I'll sell my stock. I have a price target of $28.11. So the risk is 75 cents per share and I'm purchasing 35 shares. So the total risk I would take is $26.25. And the reward is $2.11 for each share multiplied by 35 shares. That gives about $73.85 of reward. So the risk to reward is approximately 1:3. A very important thing to remember in swing trade opportunities is always keep stop losses. In case your analysis is wrong, then you get stopped out and you won't lose much capital. I hope you've enjoyed this video. Every week I'll be releasing videos on swing trade opportunities, and also on my channel I'll be evaluating the growth stocks and EV stocks. So if you are new here, please hit the subscribe button and like and share this video. Thanks for watching.